Over the recent days, we had some good articles on the PropertyEU online, in fact, about Germany and the availability of debt. Now, we know that there is no shortage thereof. However, the point I want to make is there was a reference with regards to the debt funds, alternative lenders. And that goes the question mostly to Markus as to what extent you think alternative lenders, debt platforms have a future in Germany vis-à-vis the enhanced appetite from the banks, from banks and the rest, to finance the high leverage and lower pricing. And to what extent, if they are basically a viable option, how the rest of the panel and from an investment side see this offering. Would they welcome a higher leverage at a higher price perhaps, in which case these debt funds could have raison d'etre in Germany, or you ultimately see the collapse of this proposition in the specific country?
From the bank's perspective, there are various aspects to take into account if you reflect taking a mezzanine lender after your position. Are they securitized? Do they need collateral? Do they need a mortgage or not? And how does that impact the entire rating of the entire loan? Regulations which are impacted on the bank at the moment will tend to prohibit the kind of mezzanine lender as soon as they are partly or only bit requesting the collateral. If they come as a kind of shareholder loan level down, then it's a different story. But as soon as an active lender out there providing an own product, even behind the bank position, it's kind of prohibitive to what the bank rating, the bank equity is concerned, and then it destroys the returns of the bank, or we have to ask for high pricing returns, destroys the return for the investor. The second thing is, most of those guys don't have a banking license. So they have to buy a debt which is originated already. They cannot generate their own debt. And that means if we team up with a lender like that, we need to underwrite the full risk and then sell down the portion. And that's a risk we need also to be comfortable with in case the takeout fails. These are parameters which makes it a bit more difficult than here in the UK to deal with this kind of elements. And as I said earlier, we have not seen many. We try to team up with them and other banks as well, seeing where investors require more than the senior lending part. Try to create alliances and product which allows for that, but we have, as I said, regulatory and return issues with that.
Okay, good.
Can I add something?
Yeah.
I've recently got much more involved in the debt side of things, and I think I've been sort of blown away by the complexity of it, being a sort of generally pure real estate type person, but understanding the motivations of the alternative lenders I think is key. So maybe 3 or 4 years ago, certainly in the UK, we saw a whole series of fund managers trying to create debt products because the margins were so fat. And pretty much they have all disappeared. A few have been successful. Obviously the problem is that they're all trying to launch funds at exactly the same time without the expertise they generally required. And the margins, as the banks came back to life, then the margins shrank away, so the opportunity set of those funds disappeared. The work that we've been doing more recently is with regard to our insurance clients, and I am no expert in solvency regulations, but the insurance clients are coming into real estate lending from a very conservative perspective, because the amount of capital they put against their real estate, their direct real estate, is multiple times higher than that they would put against bonds. So irrespective of the returns being much lower, the bonds are a safer haven for them. And so we are certainly aware of clients who are interested in taking participations in syndicated 5-year loans, but they would not be the originator because they don't have banking licenses. But they are not going away anytime soon because the regulations force them to do this. Very conservative, very low yields, there for the long term. I don't think that's changing.
And they have done it in the past, they just were not so visible. As such, insurance always provided loans in the sector. At the moment, they just have a more focus on it because of the other alternative investments, they don't get the right returns.